Australian homeowners are facing a wealth squeeze as mortgage interest rates are likely to keep rising even as home values fall. Normally, when house prices come down, the Reserve Bank responds by cutting interest rates, but not this time.
Rates up, houses down. In September, home values fell in 5 of our 8 capital cities. The problem is the downward trend in Sydney and Melbourne, where prices have fallen the most, and they're expected to keep on sliding.
So with mortgage rates just edging a little bit higher now, it does suggest that there's potentially some further dampening pressure on the housing market.
It's no surprise to us that prices are still falling at the moment. We think that's got quite a bit further to go, actually.
Sydney house prices fell another 0.8% last month. The annual fall is now more than 7.5%, or around $80,000. The median price is now $976,000. And as banks become more cautious in the wake of the Royal Commission, things could get worse as borrowing money becomes tougher.
The big driver of the slowdown, of course, is tighter credit conditions. We're not expecting credit conditions to ease up at all.
So the government is urging banks not to continue raising interest rates out of step with the Reserve Bank, because they know if the property market falls apart completely, it will undo otherwise strong economic conditions.
While we understand the cost of credit sometimes puts upward pressure, we don't expect them to be putting it up anytime soon.
We do think that if everything continues along this pathway, we think the RBA will be starting to increase interest rates around about this time next year as well.
For our national economy, one problem is the pace that prices are falling in our 2 largest cities.
That starts to affect overall household wealth.
Ross Greenwood, 9 News.